As the federal government shutdown drags into its fifth day, another crisis is quietly edging closer to millions of American households. John Godfred, North Dakota's insurance commissioner and current president of the National Association of Insurance Commissioners, warns that Congress has only a narrow window to stop health insurance premiums from skyrocketing in 2026. At the heart of the fight are the enhanced premium tax credits created under the Affordable Care Act. Since they were expanded, roughly 24 million people have relied on them to keep monthly premiums within reach. The problem? Those extra subsidies disappear on December 31, 2025. If Congress does nothing, insurers will have to price next year's plans without the credits, and policyholders will feel the full impact. The numbers are stark. A KFF analysis estimates the average annual cost of a marketplace plan could jump from about $888 to more than $1,900. 4 million people may drop coverage altogether, and hospitals and clinics could lose more than $32 billion in revenue in a single year. Insurers need to finalize 2026 rates months in advance, so Godfred says the practical deadline for congressional action is far earlier than New Year's Eve. Yet the premium fix is now entangled in the larger budget standoff that shuttered the government on October 1st. Democrats have vowed not to approve any spending bill unless it extends the ACA credits, calling the subsidies a non-negotiable shield against a massive middle-class tax hike. Republicans argue the issues should be separated, reopen the government first, then debate health care. Some in the GOP hint they're open to a deal on the credits, but only after federal operations resume. For now, the two sides are dug in, each blaming the other for both the shutdown and the looming premium spike. The backdrop to today's stalemate is the GOP's 2025 tax and spending package, signed earlier this year, which slashed more than $1 trillion from Medicaid and other health programs, but left the ACA credits untouched, effectively putting them on a ticking clock. That omission set the stage for today's showdown. California offers a preview of what could happen nationwide. Covered California, the state's health insurance marketplace, projects average premiums could nearly double, an increase of 97% without the subsidies. For a low-income enrollee, a $97 monthly bill could leap to $182. An older adult between 55 and 64 might see costs rise from $186 to $365. Latino Californians could face hikes of 122%, and middle-class families who currently save about $500 a month would watch those savings evaporate overnight. Public opinion is remarkably unified. A recent KFF poll found nearly 80% of Americans, majorities of Democrats, Independents, Republicans, and even self-identified Make America Great Again supporters, want Congress to extend the credits. Despite that consensus, many Republican lawmakers remain opposed, citing the price tag and repeating the false claim that the subsidies cover undocumented immigrants who are not eligible. Meanwhile, the insurance industry's calendar keeps ticking. Companies must file preliminary 2026 rates early next year. Without clarity from Congress, the safest course for insurers is to assume the credits vanish and price plans accordingly. That means millions of families could receive renewal notices this spring showing premiums they simply can't afford, even if Congress later strikes a deal. Every day of gridlock shrinks the chance of a smooth fix. If lawmakers wait until the last moment, insurers warn they won't have time to reissue rates, forcing consumers to pay first and hope for refunds later, or go without coverage at all. So the stakes in Washington now extend well beyond federal paychecks and national parks. The question is no longer just when the lights will come back on in government offices. It's whether 24 million people will be able to keep the health insurance they rely on, and whether Congress can act before the calendar, not the politics, makes the decision for them.